Thank you for joining today's educational webinar on self-directed IRA accounts. This presentation is being recorded. For those that have joined live, you can ask any questions in the chat box, and at the end of the presentation, I will open it up for questions and answers. In this educational webinar, I'll cover the basics of what a self-directed IRA is, some of the tips and tricks, some of the investment types, and options for using your self-directed IRA to participate in various alternative investments. A quick legal disclosure, this is an educational webinar. Myself, Jordan Speaker, nor my company are IRA custodians. This is not a sales pitch. You can review this in your additional time, and I would encourage you to consult an attorney or tax professional for any advice that you have regarding retirement accounts. Just a quick little intro about myself. My name is Jordan Speaker. I'm the founder of Valor Capital LLC and Matterhorn Lending Solutions. My primary day job is I own apartment complexes, and then I also have a lending platform where we purchase loans secured by residential land. As part of this path and this trek, I myself have used a self-directed IRA, and I've encountered many people who have also used self-directed IRAs to participate in various real estate investments. And one of the things that commonly comes up as people leave corporate jobs and they're looking at rollover options is the idea that they're really just not aware of what a self-directed IRA is and how it can work and how it fits into their overall retirement planning and investment portfolio. And so I wanted to take some time to put together a presentation from really a self-directed IRA user's perspective versus a custodian, which usually does these pitches, just to talk a little bit about self-directed IRAs from a user's perspective. A couple other nuggets. I have an MBA from Rice University, and my undergrad's in finance. I have a math minor. I also serve in the United States Army, and I'm a co-founder of the Vet Biz Battle, which is a veteran-focused startup competition hosted at Rice University. We started that in 2014. And so all of these events together have led me to have a lot of experience and exposure to a lot of different investment types within the alternative investment space. So let's jump into it. This presentation will go about 30 minutes. So again, if you have questions, feel free to put them in the chat box, or if you want to hold them to the end, I'll answer any questions for those that have joined on the live session. So what is a self-directed IRA? So a self-directed IRA is just a different form of a traditional or Roth IRA. And it really just allows you to access a broader array of investment opportunities beyond what you could have in a sort of a traditional or Roth IRA, but sort of a standard IRA account. In a standard IRA account, you can more or less access public equities, so stocks, bonds, treasuries, money market funds. And a self-directed IRA basically allows you to invest in a lot of other stuff. So this would include purchasing rental property, purchasing oil, royalties, or minerals, investing into companies, whether those are startups or more mature companies. And so those different alternatives all happen within a self-directed IRA. So one of the things I meet when people have IRA accounts or 401ks they're looking to roll over, the question around, I have my IRA at Vanguard or Schwab, can't I just use that? And the answer is usually no. So most of the self-directed IRAs require a specialized custodian who specializes in this particular field. And the reason for that is there's some IRS paperwork. The paperwork's a little bit different when you use your IRA to make these types of investments. And so there's specialized custodians. I'll give a couple references later in the presentation on a couple that I have experience with, but there's quite a few. There's more now than there were 10 years ago. They all have pros and cons and some cost differences. So I'll talk a little bit about that. But really, the custodian's job is really just to handle the IRS compliance for your IRA. I would in general would say this across the board. They're not an investment advisor. They're not going to provide you investment advice. They're not going to bring you investment opportunities. They're really just more or less there for the paperwork side of the business. So again, a self-directed IRA is just a different form of the pre-existing traditional Roth IRAs. So if you have a traditional IRA or a Roth IRA, both of those can be used as a self-directed IRA. And if you have a pre-existing 401k plan and you're looking to do a 401k rollover into an IRA, you can roll a 401k as well into a self-directed IRA. So let's look at the self-directed IRA investment options, and it's pretty expansive. So you can use a self-directed IRA to still make kind of what I think of as normal IRA investments like stocks or bonds, mutual funds, but I wouldn't recommend it. The fees are higher in a self-directed IRA account for those types of investments than you get from a traditional platform. So if you want to make those types of investments, I would encourage you to stay with a traditional IRA custodian, or potentially split your IRA and keep some with a traditional IRA custodian, and then move some of those funds to a self-directed custodian. So within a self-directed account, this is a short list of kind of the options that are out there. I put stars next to really common ones that I've seen people do over the years. So real estate's probably the most common that I've experienced. Of course, I'm in commercial real estate, so I'm probably biased. But it's a good use for people to use their IRA account to buy single family rentals, uh, participate in syndication deals, or even use it to buy land and either flip that land, develop that land. So people have used it for different things. The other one that I've seen that's very common, and I'll talk a little bit more about this, is really around lending. So self-directed IRA accounts and lending work really well together. There's a term out there for those that are familiar, hard money lenders. A lot of hard money lenders actually are using self-directed IRA accounts. There's some tax reasons for this, and I'll talk about this later in the presentation. But I think making real estate investments and using self-directed IRA to do some sort of lending are probably the two most common vehicles that I see people use it for. The third, I would say that's the most common, is using it to invest in companies. And so this can take a couple forms. So on commercial real estate syndication deals, that's probably the most common of investing it through an equity vehicle. But people also use it just to participate in whether it's a startup or growth capital for a regular company. You'll see at the bottom here, there are some prohibited investments, and I'm going to talk about this a little bit more. But just kind of real quick, prohibited investments include collectibles, even though they have financial value, they may change in value. So art, rare coins, life insurance policies, and the IRS prohibits these because they view these as really for your non-retirement account personal use and having personal benefit from having that. So like if you have a piece of art in your house, it's really benefiting you personally more than, say, your retirement account, where the rest of it is the government looks at these as being more beneficial to your retirement account than you personally. And that's really a common theme for how the IRS came up with the various rules that govern all IRA accounts, and self-directed IRAs fall within those rules. So setting up a self-directed IRA is actually pretty easy. There's several custodians, and now with online banking and custodian access and electronic paperwork, the process can really be done start to finish in probably less than a week. So step one, you basically will choose a custodian. As again, I said, I'll give some referrals at the end, but by no means is it exhaustive. Step two is basically doing the rollover process, which usually entails filing some paperwork with your current IRA custodian. And then they'll initiate a wire transfer to your self-directed IRA custodian. And then step three, once your account's funded, it's making investments out of your self-directed IRA. And then finally, just monitoring and tracking those investments until they come full cycle. And as you get, as you reach the point in your life where you can actually withdraw your funds from retirement, that's sort of the end all. That's the end exit plan for use of a self-directed IRA. Taking funds out of a self-directed IRA is very simple. So if you have liquidity within your self-directed IRA account, you can do a rollover to another IRA custodian at any time. It's a very similar process. Again, it's very fast, very easy. Usually the paperwork takes less than 30 minutes to set up with a custodian. And once you actually take the steps, you'll be able to get the whole process done. In general, I would say less than a week, sometimes maybe even 2 to 3 business days. So let's talk a little bit about what a custodian is. So I alluded to this at the beginning of the presentation. So a custodian is just a financial institution that has various registrations and compliance approvals to be basically a trustee for IRA accounts. And they really just handle the paperwork side that's required to make these types of investments. As I talked about earlier, most IRA custodians, so the big guys like Vanguard, Schwab, usually do not have a self-directed platform in-house. So you have to go to these specialized custodians. And really, you can see here, I've provided kind of a list of what basically a custodian for a self-directed IRA does versus what they don't do. And you'll notice a theme that really it's administrative by nature versus what they don't do, which is really all of the investment work. So as opposed to like a more traditional IRA platform like Schwab, obviously they're giving you a list of stocks and bonds and they're letting you choose for what to invest. A self-directed IRA custodian is not giving you any investment options to pick from. You have to source your own deals, which I would really say is probably the hardest part of using a self-directed IRA at the beginning is really learning to source deal flow. And then obviously you have to evaluate those deals. And then once you've decided to make an investment, the self-directed custodian will get involved. So for example, if you find a deal that you like and you want to do it, whether it's participating in equity or buying a house, the custodian will have different paperwork for you to fill out to basically give the approvals necessary to actually release the funds to whether if it's a company to release funds to the company that you're investing in, or if you're buying property to release the funds to the title company to complete the transaction. I've provided some range of fees because I think this is something that comes up because people ask me pretty often, what does it cost relative to a traditional platform? And it's more expensive. I mean, there's no doubt about it. Uh, so for accounts under $100,000, I would say you should probably expect to pay 500 to 1,000 a year as kind of a for your ongoing annual fee. And then most of the administrators have sort of a long list of kind of smaller fees per transaction, whether it's a processing fee, a wire fee, and those usually are 25 to $50 per activity. But yeah, so on a given year for account under 100,000, I think 500 to 1,000 is pretty common. If you go to accounts between 100,000 and 1 million, you're going to get into a smaller number because really once you're over 100,000, your annual fee actually starts to plateau. And you're probably closer to 1,500 as you approach 500,000. And it just depends on the fee structure of the custodian. But most of the custodians will have basically a percentage based off of your total account size. And then again, they'll charge kind of a list of miscellaneous fees. So what are some of the benefits and some of the risks around using a self-directed IRA to participate in alternative investments? Uh, Really, the benefits are you get exposure to things that have less correlation with the overall stock market. So right now, the stock market across all asset classes, whether it's technology, utilities, real estate, there's really broad correlations in the market. So like this week's a great example. Everything goes up, everything goes down. And there's a lot of reasons for that. One of the main reasons is the growth of ETFs. Over the last 10 years, ETFs buy everything typically. And so when people sell their ETF, ETFs sell everything, ETFs buy everything. And so by using your self-directed IRA, you're getting access to typically to types of investments that have less correlation and connectivity to the stock market. And this provides investment portfolios with diversification, which is important. It also allows you to access things you just can't buy, via stock. So if you wanted to buy a rental house, your self-directed account allows you to do that versus your other options. And then obviously there's tax advantages to using a self-directed IRA versus after-tax dollars. There's of course significant tax benefit from using an IRA account, period. And then these accounts just allow you to sort of compound that benefit with access to alternative investments. Some of the risks. So of course, there are no free lunches in the world. Some of the key risks that I've seen over the years, and I don't necessarily people think about this enough. Again, this is a retirement account, so depending on your age and your personal investment goals, Most of these investments are not liquid, and people don't necessarily appreciate that when they get into, let's say, like an apartment syndication deal. You know, they might be targeting 3 to 5 years, but as we saw the last 5 years, something can happen, and 3 to 5 can turn into 10. And so your money that you're planning to use for retirement could be locked up for a longer period than you're anticipating. The second challenge, and I alluded to this a few minutes ago, is that you have to source your own investments. And until you're really plugged into spaces where investment opportunities are coming to you, it takes some work to generate a funnel of investment opportunities. So once you decide, hey, I want to buy single family houses, you have to go look for single family houses now. Or if you want to participate in apartment deals, you need to find apartment operators, get on lists, and wait for projects to come up. Or if you're looking for companies, you have to find a company to buy, an entrepreneur sponsor. And these are all very tangible, high work types of activities, which is different than just buying a stock. Because of course, like if you want to buy stocks or treasuries or bonds, it's 2 clicks. Of course, you can spend time doing research, and that can take quite a while. But the actual process is very fast with stocks and bonds versus with alternative investments. The process is very slow, and it does require a lot of effort on your side to actually make the investments. Uh, I didn't put it on the slide. Of course, I would say, the question really is why are you participating in alternative investments, period? Uh, I talk a lot about this because, of course, I'm an apartment person myself, and I obviously raise money for alternative investment strategies. One of the advantages typically is that the alternative investments, usually when they're successful, have higher returns than what you get in the stock market for similar types of assets. And then, as we talked about, also lower volatility. So, you know, with a private investment, the valuation's not going up and down by the minute. So when the stock market crashes, your investment sort of holds steady state. And over a long period of time, successful alternative investments usually outperform the market on a risk adjusted basis. So that's really the advantage to doing alternative investments. And like I said, the cons again are access to your money if you need it. And this is really something, I help my parents think about their retirement, and it's something I stress to them quite a bit. As people get older, unfortunately with health, there's no certainty around your health. And so it's important to think about liquidity and making sure that you don't overextend yourself when you make these types of investments. It's important to maintain liquidity, uh, because when you need it, you'll need it. And so with most of these investments, you won't be able to access it as quickly as you like. So let's talk about some of the rules that basically limit uh, how you can use a self-directed IRA. So the next couple of slides, I get into sort of the cons or sort of the complexity around self-directed IRA accounts. So when you make investments with your self-directed IRA, there are a lot of rules that you have to be very cognizant of. And if you see, I highlighted here, really the concept of this is that your non-IRA self, so that's you as a person, can't benefit from the use of your IRA account. So I used the example earlier of artwork, and this is why it's prohibited, because if your IRA was to buy a painting and you hung the painting in your house, you are getting personal benefit, uh, basically at the benefit of your IRA account, and that's what the IRS cracks down on. When you're making these types of investments, there are very specific rules of the people that you can and cannot invest with. So the people you cannot invest with include your spouse, your children, your grandchildren, your parents, and your grandparents. So this is direct and immediate family. So just to kind of recap this, and I have some examples on the next slide. Let's say your son was was going to buy a rental house, and you were going to loan him money from your self-directed IRA. You're not allowed to do that because he's your son. Now, kind of same example, if your brother was buying a rental house and wanted to borrow money from you, you can loan the money to your brother from your IRA. So again, very specific rules around direct family lineage. And of course, the other one is that you can't loan it to yourself. So a good example of this would be if you run a business, your IRA cannot loan money to your business because you're in control of your business. The penalties for violating these rules, and I will tell you that it's hard. The IRS, I would not say this is high on the IRS's list of things to go chase down and prove, but if it comes to fruition, you basically pay the maximum tax plus it's a 10% penalty. So basically, they treat it as if you immediately had withdrawn your entire IRA. And so it's a significant tax burden if the IRS actually proves that you violated these rules. So I would say in general, do your best to try to avoid doing them. And it's not really terribly hard. But it is important to give us some consideration. Again, because the self-directed IRA is a type of IRA account, uh, required minimum distributions as you get older still exist. So you still have to take the same required minimum distribution starting at the age of 73 for a traditional IRA to avoid tax penalties. So let me go through just kind of a couple of what I call disqualification examples. So these are just a kind of couple of quick anecdotes to help you kind of understand these rules around, you know, who can you give money to with your self-directed IRA. So in the first example, you make a loan from your IRA account to a guy who flips houses, and you have no personal relationship with the house flipper. That's allowed. If you make a loan from your IRA so that you can flip a house, that's not allowed. If you invest into an apartment complex that your sister runs, that's allowed. But if you were to invest into an apartment complex that your son or daughter runs, not allowed. Or alternatively, your parents. So for a lot of people, I've seen both ways where, their parents are leading deals or their children are leading deals. And so you can't do that. But brother or sister are good. Son or parent, children or parents, no good. Um, Again, I talked about this example just a second ago. If your IRA makes a loan to a business you run, doesn't work. Uh, this one I've seen come up with a handful of investors, this last example, 6, and this is why I included it here. So if you invest your IRA, let's say, into a business or some sort of maybe like an apartment syndication, and they want to do additional work down the road, and so they do a capital call to raise more equity. Typically, people's IRAs are less liquid, especially with the annual contribution limits. And because they have limitations on liquidity for their IRA account, sometimes they're not able to make that capital call even though they want to. So it's really important to know that you're not able to commingle your IRA and non-IRA funds within the same investment. So for example, if your IRA didn't have any money, you're not allowed to put in, your own after-tax money to basically cover the delta. The IRS basically views that as your IRA, you personally benefiting from your IRA account. So again, really important to not commingle. And I've seen this come up where people either want to or feel the need to or need to. Um, so a good example is like if you bought a single family house, 100% with only your IRA account. And let's say you had to replace a roof one day out of the blue, and you didn't have any more money in your IRA, and for whatever reason you couldn't borrow money, you couldn't use your regular money to do the roof. Like you'd have to find a solution. You'd have to basically either borrow money or find a solution to use your IRA account to do the repair. Again, like you can't commingle the funds. And so I've seen people run into that as a kind of a trap. And so it's something to be mindful of as you think about making investments. Okay, so this is actually where this gets a little bit complicated. And I wanted to take a minute because I think this comes up quite a bit on both blogs and people talk about it. There's 3 acronyms that people talk about with self-directed IRAs, and it's around your IRA having to pay taxes, which sort of seems counterintuitive from what most people are used to. So there's 3 terms, what's called unrelated business income, the tax on that unrelated business income, and then this last term, unrelated debt finance income. So unrelated business income is income in something that you invest in that's considered to not be passive. So if you look at what I've highlighted in blue, the easier way to think about the definition of unrelated business income is to think about what it's not. So these are the types of incomes you want to make with your self-directed IRA because that all these tax concepts don't apply. And that includes interest, royalties, dividends, and capital gains. So the government views those four types of incomes as passive, and those are IRA friendly income sources. The government in general does not like operating income. So a good example is if you invested, let's say, in a manufacturing company that was successful, that company is going to generate quite a bit of operating income. And that's going to fall into what they call an unrelated business income. And you're going to have to pay taxes. You're going to have to pay regular taxes on the income from that investment, which sort of defeats the purpose of having a traditional or Roth IRA in the first place. But there's situations where it can make sense. And I'll give you a couple examples on the next slide where it still makes sense. So again, it's generally operating income within a business. So if you own a single family rental, they consider that to be rental income. Rental income is passive as well. So again, it's predominantly businesses. It can also come up with apartment complexes, which I'm gonna get to with debt finance. But usually it's rental income, interest, royalties, dividends, and capital gains. So now this last one. So unrelated debt finance income. This is where it gets a little bit murky. So if you were to buy a piece of property and you didn't have a mortgage on it, so let's say you find a rental house, it's $200,000, you buy it with all cash from your IRA account. All of the income that you would get from that rental property all goes back to your IRA. You don't have to worry about any tax. It's all good. Now, let's say you have 200,000 in your IRA and you want to buy a bigger piece of property, or I guess I have an example here. So you buy a $100,000 house, but you take out a mortgage for 65,000. You're going to actually pay taxes on 65% of the income generated by that property. And that percentage, that 65%, is determined by taking the mortgage over the total price of the property that you bought. And this is both true for real estate and for businesses. So if a business has, a sizable loan on it, this will also apply. And so what this means is that as you're making money on the property after debt service, you're going to actually have to pay taxes on a pretty big chunk of the income that you make. And this includes capital gains. And so it's important to understand when you're using your IRA, while real estate is probably one of the most common ones, once you add debt, which generally most people do to make the returns make sense, you have to worry about this tax burden. But I'll show you a couple examples where it's actually not as bad as it sounds. So I provided just kind of 6 simple examples to walk through these complex tax kind of related items. So I'm just going to walk through a couple of these that I think are worth pointing out. And again, you'll have access to these slides and presentation since you registered. And if you have questions afterwards, looking through them, feel free to reach out. I'm happy to talk through them with them more because it is a complex area. So in the first example, this is if your IRA makes a loan. So very simple, your IRA makes a loan, it makes $10,000 a year. Because it's a loan and it's interest income, no tax. So this is what I was talking about earlier. A lot of people use their IRAs to make loans because it's one of the simplest ways. They usually have a more secured position by making a loan. And so, they're really strong risk-adjusted returns. And I've seen a lot of people use their IRAs very successfully in that space by using loans to make money for their IRA account. So the second example, and this is where I'll kind of contrast these because I think this is really important. If you buy a property and you only use your IRA, whatever money it makes, there's no tax because it's all rental income. Now, so let's say, so I use in example 4, I take similar rental economics, but just made it a bigger house. So as opposed to a $100,000 house, now it's a $400,000 house. You take out a mortgage with 4% annual interest. And so if you just kind of do some simple back of the napkin numbers, what you have is basically the property is now making $8,000 after debt. And so because the property's made $8,000 that year, but because it had 75% of the purchase price was debt, you have to pay taxes on 75% of that 8,000. So what that means is that your tax basis is on 6,000 of the 8,000, not that you're paying 6, because then you have to multiply it by your normal tax rate. And so for this example, I think I used 30%. For most people, their weighted average tax rate for operating income, assuming you don't make 5 million a year, you're once you include all the tax brackets, you're probably between 22 and 25 if you want to think about it. But as you see in the example I provided, by using positive leverage, you actually made more money even though you paid tax. So while everyone's always trying to avoid paying taxes, there are situations and times and uses where paying tax isn't necessarily the wrong outcome because you might be making more money. I've seen people many times avoid making more money because they try to avoid paying tax. And so really it's important to understand that, nobody wants to pay tax. I'm right there with you. It's not always the worst thing. So you really have to look at the investment options that you have, compute the tax when you run your due diligence and your modeling, and then decide if it makes sense for you to make that investment. I included a couple other ones, and the C Corp was less common than very few people will actually make this investment, but I wanted to point it out because it's kind of one of those other weird items. So a C Corp pays taxes on its company income versus passing it through. And so because it already pays tax, your self-directed IRA doesn't pay additional tax compared to these other items. And so basically, once you take the corporate tax, your net out income stays with your IRA. There's not an additional tax on it. Okay, so this is the last slide. Sorry, I'm losing my voice here. So bringing it all together, just to kind of recap. So a self-directed IRA is just a type of traditional or Roth IRA account with a specialized custodian. You use a self-directed IRA to access a broader array of investment opportunities within alternative investments. And we talked about this. Common examples include purchasing rental properties, participating in syndication deals for commercial real estate, lending money to either individuals or businesses, I live in Texas. Minerals and royalties are very common uses of self-directed IRAs. The other thing I didn't talk about, but I think this is worth mentioning, is a lot of private investments, even though they're not liquid, and I did talk about a lot of them have long investment horizons. And so those long investment horizons typically match, your intended purpose of your retirement account. Your retirement account usually for most people is money that they're thinking about, wanting to build over their life. And so these long-term investments match that type of profile. And so while it might not necessarily move as fast as the stock market, usually you're getting kind of more slow, steady, predictable gains in your retirement account, which make them very attractive for retirement purposes. On the last slide, I talked about, I gave you some examples of where you will have to look at and consider paying taxes. So if you want to avoid paying taxes with your self-directed IRA, I would really suggest, looking at lending money, owning equity in an investment that generates qualified income. So as an example, if you use your self-directed IRA and you basically buy REITs, that qualifies as qualified income and you don't pay tax. Or if you invest in a business that buys loans, because those loans generate interest income, you can avoid paying taxes that way. And just kind of wrap up the tax point, again, nobody wants to pay tax, but it can be justified. And so it's important, and I would encourage you to model when you look at options, whether you want to use debt or not use debt, but just run the numbers and decide what makes sense for you. And if a lot of times paying taxes actually means you're making more money in totality. So I would say it's worth taking a look at. Uh, the last nugget, which I've kind of teased out over here, here's a couple of links to two custodians I've actually worked with quite a bit over the years. Uh, Pacific Premier has bought up several other custodians, which is how I've come to know them. Uh, they're very large. They're one of the larger custodians for self-directed IRAs. They're very fast. Their paperwork is very thorough. A lot of it is done on an online portal, so I would say it's generally, customer friendly. The one thing I will say is they're more expensive. So they have kind of the higher end of the annual fee structure for using them. A lower cost option, and it's because their business model is a little bit different, is American Estate and Trust. This is a company that is new to me. I started working with them in 2024 so far, and I thought I've been reasonably impressed. So the different with American Estate and Trust is they actually approach people like me to help, connect them with self-directed IRA custodians, where Pacific Premier basically spends a lot of money marketing to find people on this call to set up a self-directed account. So American State and Trust basically saves a lot of money by finding kind of connectors like myself, who, you tell me, hey, I'm thinking about a self-directed IRA, and I make a referral. I don't get a referral fee from either, so feel free to use whoever you want. And like I said, there's a lot more custodians than just these two out there. All the fee structures are pretty similar. So really what I'd say is it's important to find one, make sure they have all the necessary certifications and compliance items. And then, overall, if you like using them, it's good. One other tidbit that's really important that I would kind of point out, because I don't think people know this once they, use a self-directed IRA. Let's say you invest into a business and your custodian raises its fees, you can actually move your investment through a rollover without having to liquidate it to another custodian. So if you get to the point where you're frustrated or you dislike your current custodian, you can move an invested asset over to another custodian. So the custodian is not just holding their cash, they actually are holding the asset that cash bought. So that asset can be rolled to another custodian. So just kind of a fun point to mention. Anyways, that's all I had for today. I hope you found this useful and constructive. I'm gonna allow everyone to unmute themselves here. For those that are here live, if you have questions, feel free to ask. If you prefer you can add it in the chat bot. And just as a reminder, before the Q&A session, this session is being recorded and will be distributed to everyone on the registration list. All right, I'm gonna allow everyone to unmute themselves and feel free if you have any questions to ask away.
I got a question, Jordan. Appreciate you doing this. As far as rolling into self-directed sounds pretty self-explanatory. Can you then roll back into called Charles Schwab Fidelity or whatever after maybe your investment completion date or whatever that is later on down the road?
Yeah, that's a great question. And the answer is yes. So if you have a regular IRA custodian now and you roll to a self-directed, you make an investment, that investment pays out, and you want to go back to Schwab or Vanguard or one of the other guys, you can always do that as well.
Okay. Yeah, I asked that because as far as like minimum distributions, if you have to start taking out at 73, but you're in the middle of a project there, if you have to start pulling, then you'd have to switch back over or something.
Yeah, or you basically need to split, because my understanding, and this again, my understanding as a user is that it's based off of your totality of your entire IRA accounts. So like if you have 5 IRA accounts, that minimum distribution is based off of your total pool of IRA investments. So what I've seen some of the older guys that I know do is they'll basically keep some in stocks so that they can use that for their minimum distributions, and they still have other money tied up in longer term projects.
Gotcha. Thank you.
Any other questions on the line?
I'll hit you with another question here.
Sure.
accreditation, is that kind of filtered through the self-directed, or is that more on the back end, call departments and yourself? Is it where does that
Yeah,
accreditation?
that's a great question. Yeah, the custodians aren't involved in the accreditation. You're talking about sort of from when looking at investments, they're looking for accredited investors. Is that right?
Right. Yes.
Yeah, so the custodian doesn't do any accreditation um, activities. So either you will have to attest to it yourself, depending on the type of investment, or a lot of people have a service. If you're doing kind of a cold solicit project, usually there's a service that does it, and so that's who handles the accreditation side. The other part, from my understanding, I've talked with our securities attorney before on this because I've raised a question is, is it so if your money is in a trust, you're talking about accreditation of a trust. But for an IRA, they count the IRA still as you, so it's accreditation of all of your money, both IRA and non-IRA. So I think that's something that's important to note is that it's not accreditation of just your IRA or just you personally. It's a combination of the two of you together.
Gotcha. So if you need a net worth of whatever number, call it 500 grand, it's not just your IRA, it's your total assets there.
It's your total assets. Now, if you were so, and I contrast that because some people basically, as opposed to an IRA, set up a trust. The accreditation is just the trust. So, but for an IRA, it's your regular money and your IRA money combined, or your IRA assets and your regular assets combined.
Okay. Okay. Appreciate it.
Well, I want to thank everyone for registering. Appreciate the support and the feedback. If you have any questions or if you think of anything, feel free to send me an email. My contact information will be sent when I send out this presentation. Happy to share any more thoughts. Really, just trying to provide more knowledge and support and education in the space. So, thank you for taking time on a Friday afternoon, and hope you all have a great weekend.
Thanks, Jordan.